Hey, good afternoon. This is Tech Talk Tuesday, and today we want to take a look at what the technical indicators are telling us over the short term, as well as the intermediate term ahead of tomorrow's conclusion of the FOMC meeting for September. And actually, we're getting two different pictures at this time. I want to take a look at some short-term and long-term charts, and then we're going to look at some sentiment readings that might be telling us whether or not we're headed to new lows or maybe we've already seen the bottom. Okay, my name is David Blake, and in the seminar or webinar, I hope you have some questions for me, whether it's about individual stocks or questions about the overall market. Okay, like last week, we don't have much to go on after Monday. Stocks drifted lower on yesterday on very low volume after some weak factory production out of China overnight, sent the Asian markets mostly lower. But the major avenues were kind of stayed in there within their triangular coil pattern that we've been talking about the last couple of weeks. With the September FOMC meeting starting today and culminating tomorrow with the decision on rate hikes. We may see some wild swings intraday ahead of that time, but that's basically just some traders trying to front run the decision. It's not going to really give us an indication of true market action. But anyway, I'm not going to pretend that I know what's going to happen with the rate hike meeting, but my gut feeling is that except for a short-term pop or sell-off, the decision isn't going to mean all that much to the market. We probably will get a relief rally, I think, because it just takes some of the uncertainty off the broader market for investors, and that's always a positive. But then we'll start to concentrate on some different things. What I want to look at today, though, are some projections for where a relief rally could go. Now, over here on the Dow Jones, which is the first chart, we're going to look at the 50% retracement from the old high, and generally this is a place where you can see some resistance levels come into the market. If we run into resistance here at the 50% retracement level on the Dow, that's going to be about 16,860, maybe 16,9. Today we're up to about 16,550. We're up about 183 points, so perhaps we're getting a relief rally before the meeting even comes out. But if we get a pop after the Fed announcement, I don't expect the market to get too much higher than that. If it really gets cooking here, everybody decides to jump on the bandwagon that we're not going to have any more rate hikes for quite some time. You could get a rally up into the 50-day retracement or 50-day moving average, which would come in around 17.2. Now we are getting some positive divergence down here in the short-term indicators, which is the reason I believe we will get further pop to the break north of this triangle. The MACD on the short term, that's 12.26.9, gave a bullish signal the other day. Also, the 9-day RSI is showing some positive divergence and showing positive momentum in the Dow Jones already. However, if we go out longer term, this is the S&P 500. Okay, with a 50% retracement on the S&P 500 comes in up here right around 2,000. We haven't made it up to that yet. I think we have come close to it a couple times. But if this rally takes us up here and we're able to crack through this 2,000 level, we actually could get a rally up to about 2045, which would be the 62.8% recovery from the bottom to the top. That would probably be the max that we'd be able to squeeze out of this. Again, you're seeing positive divergence in the RSI and also in the MACD on that. Longer term, here's the NASDAQ again. And what we see on here is a little bit different than the triangle pattern that we see on the Dow Jones and the S&P 500, although you do have much of the positive divergence down here. Again, you have a buy signal on the MACD short term and positive momentum on the 9-day RSI. You have what we call here a rising wedge, which is actually a bearish pattern. This would take us up here almost to about 4,900 possibly, break out a little bit to the upside, and then if we come back down here and break below this 4,800 or around 4,780, that would be a continuation pattern down, which would give us inclination that we'd probably go back and test the old lows down here. But for the short term, I do think we're going to go up here. Today we're at 48.45, so you can probably get about another 100 points from here, even if the NASDAQ could rally on a relief rally. Okay, another chart that I've talked about, and I actually think this chart is one of the most important that we're looking at right now. That's the Dow Jones Transportation Index, which basically led the broader market lower. But over here we can see that we had a little series. We've run a nice rising trend line over here. Have some resistance up here around the 80 level, somewhere in that level. But if we can break out above this 50-day moving average, which right now comes in at around 81.31, get up around this 82 area, that would be very bullish for the broader market. Again, we're seeing positive divergence, which shows that we're probably going to get a pickup down here, a little relief on this, and it could lead the other markets higher. RSI is up in the 60s on the Dow Jones Transportation, which again, positive divergence, and that could, the extent that this goes, could if you see this up here around 82.50 or so, that would probably add credence to the fact that the S&P could get up to around 2045, and the NASDAQ around 49.80. Okay, here we're going to look at the weekly chart for the Dow Jones. Again, this is going back, I looked back to the 2009 trend line. If we take a look at the Dow Jones longer term, we've broken below the trend line going back to 2009, and it's been struggling to get back above that trend line for the last couple of weeks. It did break all the way down to the 200-week moving average, where it bounced off of. This area right in here right now is where the 150-week moving averages comes in, and we're seeing it has gone above that. Again, if you see the 50% retracement even on the weekly chart, you'll see that we're going to run into some problems up here around the 16.8, 16.850, that area. Okay, the S&P 500. Again, you can see we broke. We also, it's a little bit better shape than the Dow Jones, but again, it's still traded above the longer-term trend line from 2009. We went down and bounced off the 150-week moving average. However, the technical indicators, if you look over here, are all negative. Here's the MACD long-term, which measures the intermediate-term trend, still bearish. The 14-week RSI is also bearish down here around 35, and these are showing that the underlying strength just isn't in the longer-term picture. Let's take a look at the NASDAQ. NASDAQ is even better shape than the S&P 500. It hasn't tested its longer-term trend line yet, which is around 4,000. But if you do come down and test that, that would coincide basically with the October 2014 lows, which is probably where we're going to end up going back to test if we run out of gas on this relief rally with the Fed meeting. And also you can see here the longer-term trend lines, or longer-term technical indicators have rolled over. The MACD bearish, and also the RSI 14-week is also bearish, is going in here showing negative momentum on the broader market. So those are some indicators that you want to watch. Okay, before we look at some of the sentiment indicators, I want to look quickly at some of the internal breadth numbers, which we kind of go over every week, see if we can gather anything from this. These internal breadth readings are leading indicators, and they can basically will tell us if the market's finding some more accumulation or deterioration, distribution in the markets. This is the NYSE Advanced Decline line. It topped out over in here the last week of April. The market topped out somewhere over here in towards the end of May, and since that time we've been seeing a series of lower highs and lower lows all the way into where we sold off. Now we are seeing some sideways motion in this. Came back down yesterday. I'd like to see this on a short-term rally break up to around 318. These charts you can find on the Market Edge homepage. On the upper right-hand corner, click on Market at a Glance, and you'll get these charts that I'm showing you right now. But this is a leading indicator, and right now it's just kind of showing you we're kind of stalled in a sideways pattern. Here's the NASDAQ Advanced Decline line, just like the not much difference here. Lower lows, lower highs, but we are seeing a little bit of positive divergence in the AD line for the NASDAQ. We want to watch that. It would take a run up to this level of 322 area before we see some maybe we have put in a bottom. Okay, now we're going to look at just limited time here. I want to look at some of the sentiment indicators, which are going to measure how bullish and bearish the market participants are. And professional investors and traders are going to keep an eye on these indicators, because historically, whenever investors get too bearish, it's kind of usually a good chance to start accumulating stocks. Conversely, when they become too bullish, it's an opportune time to to maybe cash in some chips and take some money off the table. I want to pull up a couple of the charts you can find again on the Market Edge homepage at the numbers at a glance link. Okay, the first one is the CBOE put-call index option ratio. What this number reflects, it's a 5-day moving average of the number of CBO index put options divided by the number of call options that have been purchased on a daily basis. Okay, if it gets above 1.70, that's bullish. That means there's a little bit excess bearishness in the market. Between 1 and 1.69 are neutral, and below 0.99 are bearish. Okay, a low number means that there's few investors are buying puts, and a high number indicates that traders are betting the market is going to go down. Okay, this market doesn't really tell you a lot until you get into some extreme levels. Below 0.80 usually tells you there's an excess of bullishness in there. When we get above 2, maybe 2.10, that's usually a safe time to test the waters. Back in 2013, when we went through the taper tantrum, the put-call ratio was several times went up in the 2s. And, of course, that year the S&P 500 returned almost 30%. So until it gets to these extreme levels, it's not telling us a heck of a lot. And right now it's just kind of neutral at this time. Okay, next chart is the VIX. And we've talked about this the last couple of times. What's important with this is when you see the VIX, the VIX, it's actually the implied volatility in the index options. It kind of signals the current advances kind of run its course, but low readings are going to signal complacency when you get down here in the 12, 10, 11, 12, 13. High numbers just show they gauge a fear in the market. Okay, the numbers are going to trend between 1 and 100, but what is noticeable in this thing, when you get to see the VIX spike above about 35, it generally is going to tell you that we're going to possibly have a correction. Back last year around in October 2014, the VIX got just above 30, but we didn't get above the 35 to 40 level, which we did this week. Now, if you look back here in 2011, our last correction we had in the market, it did spike above 35 and 40 several times, and then it worked its way down. And what you want to pull out of this is that when we do get above that 35, 40 level in the past, it's signaled that it's taken maybe anywhere from 6 to 8 weeks to even a couple of months before the market was correcting itself and showing signs that we were beginning a new trend higher. Here we are back here in 2010. And of course, back here in the financial crisis, this took several months. In fact, it took almost until March 2009 before we started coming back down to some levels that we're showing that we're getting back to normal. So the VIX, if you see it getting back up above 35, that's probably going to indicate that it's going to take us a little bit longer to pull out of this correction that we're currently in. Okay, one of the most used, and actually I put a little bit more credence in this sentiment indicator, and that's the percentage of bullish advisors. And this chart shows the percent of investment newsletter writers that are bullish on the market. Okay, between 0 and 40 is generally bullish. That means the investment advisors are a little bit too bearish on the market. 40.1 to 54.9 is neutral. If we get above 55, that's bearish. Again, most of these are, when they get to extreme levels, which we'll talk about in a second, that's when they can signal that we may be at a top or a bottom. Okay, most newsletter publishers will utilize a trend following method. As a result, this indicator usually will trend with the market, but when the market trends higher and more advisors jump on the bandwagon, we'll get this level up in the 60s and 65 even, and that generally means that everybody's too bullish. If everybody's already in the market, that just means the amount of available cash to fuel a further advance is declining. So that's why you want to look at this. When everybody's too bearish, that means they pulled their money out of the market, like where we are now. Right now, that means there's a lot of cash on the sidelines to put in the bottom. Okay, last week this number fell down to 25.7%. It was up in around 61 early in the spring. This was the lowest reading since March 2009, and that was the bottom of the bear market brought on by the financial crisis. Okay, now the next one is the weekly bearish advisors. This has been trending along right around 14, 13 all year long as far as the spring went. And this climbed to 27.9, and that's its highest mark since the fall of 2012. So you can see that these are contrarian indicators, but extreme levels, they start to get fairly accurate. and we are starting to get levels that have historically announced that we may be nearing a bottom. Okay, we have one more thing I want to look at, and this I don't have a chart for this, but I wanted to mention this anyway, and that is the traders look often at how many stocks are trading above a 50-day or 200-day moving average. Okay, last Friday, only 19.3% of stocks were trading above the 50-day, and 23.6% were above the 200-day moving average. These numbers bottomed the week of 8/28, when only 13.7% of the stocks were above the 50-day, and 22.4% were above the 200-day. Okay, now this reading will signal that the market is too oversold or too overbought. And again, when it gets to extreme levels like these last couple of weeks, that's a good sign that investors may want to start wading back into the market. Last October 2014, when the market bottomed out, the readings got as low as 15.5% of the stocks were above the 50-day, and 24.3% were above the 200-day. So we're close to that. The last correction we had, which was in September 2011, it got down where we only had 10.4% of the stocks above the 50-day and 13.5% of the 200-day. That week, I know the Dow was down about 6.5% that week, and that marked the bottom of that sell-off. So these are another number that we want to watch, and you can find out different places in the web. Okay, someone asked me to go over some of the sectors that we didn't do it last week, and I want to wrap this up because we're going to run out of time. But just right now, I think we're probably going to get a bounce here from the FOMC meeting, whether they raise or not. Just again, it takes out some of the uncertainty. But I want to let you know some of the if we do get a bounce, where you might want to you may get the strongest bounce, and also know that I think we're going to run into resistance, and some of these stocks, these areas, you may not want to even try to catch a bounce on that. First off, we have the materials sector on the short term. You can see over here we actually do have some positive divergence where it bounced off these lows. It's been going sideways here. That kind of coincided with a little bit of a rally in crude oil. And we have the RSI 14-day is moving up. I'm underweight on the materials sector. I still don't like it as much as some other. I'll show you why. This is the longer-term chart on the sector. This goes back to 2009. You can see where we've bounced off of that, and we actually have broken the longer-term support. I don't like to buy sectors that have broken these support. We're also struggling to find the 200-week moving average down here. It's likely that we're going to come down here and test this. But you'll look at the indicators on the materials sector. The MACD is bearish. 14-week RSI is bearish, negative, showing negative momentum in that sector. And this is a 30-day stochastic that I like to look for trends, and also to show when the trend's overbought or oversold. You are oversold on this dip over here, but you're not starting to see any build-up or any kind of positive divergence on these longer-term sectors. Okay, another sector that I'd stay away from, other than a short-term bounce with some of these beat-up oil stocks, that's the energy sector. Here you can see the line, the trend line coming down. This last rally didn't even make it up to this trend line that's been in place since for most of this year. Didn't even make it to the 50-day. You did see some positive divergence here on the indicators with the momentum going positive, but the MACD looks like it rolled over yesterday as a short term. That's a 12.26.9. Now you are up a little bit today with oil, but I'm not sure why that is. I would stay away from this sector unless I'm just buying something for a quick bounce on a really bad day. And this is why. Here's the long-term energy sector. This is a classic trend reversal chart where you found support going up here for several years. You broke below the long-term support line, the trend line. You came up, tried to get it back above it 3 times. You failed all 3 times, kept going lower. Now you're having lower lows and lower highs, and you just got a death cross with the 50-day or 50-week moving average and the 200-week moving average. The indicators down here are negative. Negative momentum over the longer term. I would stay away from these unless you get a very oversold bounce just to trade something in there like that. And also, if you look at the last week, we talked about the USO and some of the oil sector, or the oil industry. I don't like that. I thought the line in the sand was around $45, which we were unable to hold this last week. That looks like it could go down and test at least $40, maybe lower. Goldman Sachs put out a report that they think it could go to 20. But last week's rally that you saw had a pretty decent move. Looks like it was short-term short covering in that, and the people are probably going to start shorting the stock again. Okay, we have the industrials, which I'm not wild about the industrial sector either. I think you have a few stocks that do get most of the revenues here in the States, could outperform. You have some positive divergence over here with the RSI, the 14-day RSI, and the MACD. You've had a quick pop up here to the 50% retracement level on the short term. That's probably where there's any rally in industrials would stall again. That's right around this $53 range. That's XLI if you want to pull up a chart on that yourself. I don't expect that to go much further than that. Longer term, again, we started to break this on the longer term trend line, but we now are crawling back above it. That is a little bit of positive divergence. That's a plus. But again, the indicators, technical indicators, are still bearish on this. RSI has kind of rolled over. I don't see an accumulation in that chart. If you do decide to nibble on some of the industrial stocks, I would keep it to the stocks that tend to get most of their revenues stateside. Here's the technology sector. Short term, I like it. We have positive divergence on the MACD. We have accumulation down here on the up-down ratio, and also RSI is going positive. We're bouncing off this 50% retracement level here, and this is kind of tough to actually show retracement levels because that fallout on the 24th or 28th of August showed us the problem with trading ETFs. We run into a problem there where some of these ETFs were off 25, 30%. If you had stealth stops, you got crushed on these things. So I don't know whether the true bottom would have been up here around 35 or not. I took about halfway of what it sold off to use that. And if that works, then we've been bumping up against the 50% retracement level on this ETF. If we get a relief rally here, you could see this pop above that, and like the NASDAQ, go up and test its 50-day moving average. So I do like the technology sector here. In here, I would be overweight. Longer term, you were able to hold above the long-term trend line. Here again, it shows you that ETF falling out of bed. I don't like that, but you don't know how true that is. But the longer term, the technical indicators are still bearish, negative momentum. But it's not as bad. You're holding above this. Any kind of pullback, if we see anything, I would be a buyer of the tech sector, and I would be overweight. Here's the consumer staples. This includes Kimberly-Clark, Colgate-Palmolive, tobacco stocks. These are stocks that people are going to buy no matter what's going on. But short term, again, we see some positive divergence. It doesn't look as strong as the technology sector or consumer discretionary or the healthcare. But if you want to look at some stocks in here, maybe for their dividends, you are having a little bit of positive divergence in that, and I would you should probably get a bounce, but I don't know if you'll be able to get above this 50% retracement line. As you can see, that kind of goes back to the bottom of the former trading range that the stock was in when it traded sideways all year, and that's going to be a real struggle for it. Longer term, it's not too bad. This would be a place that you can nibble on some pullbacks. If you see this thing come back down to the XLP, as in Paul, come back down here to around the $45 level, that might be a place if you're looking for some dividends where you could buy some stocks on a more conservative basis. This is a conservative sector. So if on a pullback, if you're more inclined to buy that type of stock, that would be a place to go. The financials, this actually is one of the sectors that actually benefits from a rate hike, but I don't know if a quarter point is going to do much for the overall sector. However, you might get a bounce on this. Again, this is another ETF we saw just completely didn't have a bid on that pullback. That's caused a lot of concerns on the big board as far as how to trade these things. But the XLF, if we went about partway down, we can see it's been running into resistance up here around 23 and change. We would need to see it clear that. You're close to getting a death cross here on the 50 and 200 day on the short term. If we get a rally in the financials, you could get up here around 24. I think that would be a stall out there. And that also, again, coincides with the bottom of the trading range that sector was in, the broader market was in going back to February. So that's going to represent a lot of resistance in that level. And longer term, you can see where it's in better shape. Again, this spike down, you don't know how much, where the true value was, but we are seeing some negative, where the different technical indicators are going negative. And I would probably wait on this just to see if you come down and test these lows around in here, and maybe even wait for the trend line to hit on that. Here's the healthcare sector, and I'm going to wrap it up here pretty quickly here. The healthcare sector looks in good shape in the short term and the long term. Positive divergence on the technical indicators. Biotechs are maybe a little bit overbought, but some of the healthcare stocks, healthcare insurance companies, healthcare devices, stocks like that would be a place where I would probably look to buy stocks. If you go into the Market Edge site and pull up some of the different industry groups in healthcare, it'll give you some of the stocks that we are still long at this point, or maybe some early entry buys. It would be stocks that, if they outperform on this bounce, that a relief rally. If the relief rally fades and we come back down and test, those stocks that you see in the healthcare and consumer discretionary stocks like Home Depot, maybe some of the home building stocks, those are going to be the stocks that are going to be bought up by the professionals if we go back lower. So keep an eye on a relief rally. Stocks that you like, that you sit on the sidelines, you don't get this time around, watch what outperforms. Those will be the stocks that you can go into when we start to bottom on this market. I'm going to open it up now for some questions. Not sure what we're going to do, but just as a summary, I think we're going to get a relief rally no matter what the Fed does tomorrow. We may be in the process of having a relief rally currently. We're up about 180 points today. So whether we get a hike or not, look for the market probably to go up at least to the 50% and maybe a little bit higher than that. Okay, after this rally, though, I think we're going to run into some resistance. The traders are going to go back. They're going to focus on China's slowing growth. That market was down another 3% today. We're going to have some emerging market currency problems if the dollar gets stronger in here. And also then the focus is going to start to return to third quarter earnings, which start to roll out in about 3 weeks. Now, according to FactSet research, at this point, analysts are looking for earnings to be down about 2.4% for the third quarter, and actually about 2.8% lower in revenues. That's going to make 3 quarters in a row where we have lower earnings and revenues, and I don't think that's the recipe for run the new highs. So concentrate on some of the resistance areas that you see in these charts that we've talked about earlier. That's probably where we're going to run back. If you see some of these triangle patterns or see the resistance start to pick up, the selling continues, it's likely that we will go down here and test the lows, which coincide kind of with October 2014 lows. If we come down and we see some positive divergence and we stay above the October 2014 lows, that would be another sign of positive divergence. It would mean that we're starting to work on a bottom, and you can begin to wade into the market. So if we have any questions, I don't see any at this point. Everyone has a chat box that they can click on. Anybody who joined the meeting a little bit later, this will be up probably within the hour on our website. If you log in and go to the markets page, at the very top is a light shaded green area that will have a link that says listen to it. You can pick up the whole thing and maybe go over some points at that part. Also, if you have any questions you think of afterwards, please feel free to email support@marketedge.com or the doc at marketedge.com, and we'll get to those. Otherwise, we'll see you next week. Should be kind of an exciting couple of days, and maybe after this meeting we can get back to normal. And I'll talk to you next week.